Welcome to the Long-Term Investor. Today, I'm joined by Dr. Preston Cherry, who is the head of financial planning and assistant professor of finance at University of Wisconsin-Green Bay. He is also the president of Financial Therapy Association and host of the new podcast, Life Money Balance. Preston, thanks so much for joining me here today.
Peter, appreciate it. Thanks for the invite.
Well, you and I don't know each other that well. We only have known each other through social media, and we got a chance to talk a little bit ahead of the show. But I know that you're a lover of music. I don't think you know this, but I am a musician and my family's in the music business. So before we dive into some of the things that I would consider you to be an expert on, maybe you can show us some of your expert music skills. What are you listening to these days?
Well, I like all genres of music. So I like classical, hip hop, R&B, like 70s, 80s, 90s R&B are my thing. Right. So I grew up around vinyl, and the albums that you see behind me, one of them I added to my collection, which is Maxwell. But the Stevie Wonder, Songs of the Key of Life, which is my favorite album of all time. The actual album that you see behind me, I actually was a baby sleep next to this album because it came from my dad's record collection. And I wanted his record collection all my life, and he wouldn't give it to me. And so when I graduated and for my master's degree in 2006, I think it was around, 28 at the time, 27, 28, I don't know what it was. But anyway, he said, come out here and have a smoke with me, son. I was like, oh, okay. So I didn't smoke at the time, but he said, come out, have a smoke with me. I was like, okay. So he said, pop the trunk. And when he popped the trunk, he had his records in there. He said, this is your graduation present. So that's, yeah. So Songs of the Key of Life. That's what's up.
That's so cool. Well, so, what's interesting is I still miss the album because on our phones, and I happen to subscribe to Apple Music, and it just bounces all over the place, which is great. I have access to everything, but I do miss the listening to an album beginning to end. The other thing, and I'm curious about you, is once you leave college and once you kind of get older, discovering new music for me is more of a chore. Like, it's more of a risk. I only have so many hours in the day to listen to music, or minutes. I shouldn't even say hours, minutes. So I don't try as much new stuff. Do you find yourself kind of still leaning on your favorites from the past, or are you still mixing it up with new stuff?
I mixed up with new stuff, but to your point, I listen to music all the time because it helps me get through my day. So I don't necessarily watch a lot of TV unless I'm binge watching something. So or watching a good movie, a good film. I like a good film. So I love the arts. I write poetry. I've been doing that for like 30 years. But I listen to music a lot. It gets me through the day. And now, because I'm constantly thinking and getting through things, I can't listen to something new unless I'm focusing on it, because I want to listen to what's new. Yep. The new arrangement, the new beat, the new language, the new whatever it may be. Now, if I'm familiar with it, I necessarily don't have to focus on it. I know it's in the background and I can move and groove to it, but it's not my primary focus because I'm so used to it. But I need to hear it because I need it in my spirit.
So I'm the same way. If I'm doing deep focused work, I'm better off with wordless music to begin with.
I agree with you.
Or something that I'm so intimately familiar with that it's basically background noise. And I will say, when I get like real worked up about something at work or in life, I pop in my earbuds and I go take a walk. And I wish more people would do that. We're currently recording this at a point in time where the market is down quite a bit. We're not in bear market territory, but we're down 14, 15%, I think, as of this very recording. And a lot of times I want to just tell people, hey, why don't you take a walk and listen to some calming music? And, I think one of the things that I see in your work is talking about just setting some emotional expectations on the investment side. I was hoping you could talk a little bit about why and how that helps manage moments when we do get a little bit more worked up.
Yes. Smooth jazz, by the way. Yes. But anyway,
yes.
But when we set up expectations on the front end, and when we tie our investment expectations to what we want to do across our life, all right, and when we're decoupling investment management from investment planning, they're two separate things. They're two separate things. And when we are setting expectation of what we're going to experience over the long term, and we're having that conversation with clients, with ourselves, okay, and we're saying, what is our purpose? What is our time horizon? What do we want to experience? Okay. And what is to be expected? All of that goes into, okay, so when the time arrives, then and there's some education that has been introduced on the front end. Okay, we know that these times were going to come. We know why we're investing. We know how we're investing. These things are going to come or arise. So once we have that expectation up front, we have that education up front. We have that conversation up front. We have our why, our purpose tied to what we're doing. We have stories aligned to our investment strategy. Okay, that all that is purposeful. And so when the turbulent times do come, then we have a framework to revisit during this time, because we do have to be empathetic when these times arise and listen to it, because it feels differently real time. It does feel different real time, and it's okay to have those feelings. But then we can also say, okay, yes, it's okay to feel these things. Now let's revisit our conversation that we've had, the why, our education, our experience, and our expectation.
Yeah, and those are all things you can control. Those things
Correct.
that you're talking about, you can control your why and your purpose. You can't control why the market's going up and down. And so it's really sort of a futile exercise to try to worry about why things are happening in the market. It's fine to understand if you want to read the paper and understand what's going on in the world. I'm not so much talking about that, but trying to understand the level so that you can predict what's next. That's not going to do anything for you, right? And I love that you call out the difference between sort of decoupling the investment planning from the investment management. Because when I think of investment management, I think of security selection, I think of rebalancing and tax loss harvesting and asset allocation, all important stuff that we can maybe get into. But maybe talk a little bit more of what you feel like are the different components that make up investment planning.
Right. So when you're talking about planning, I love, ing words, because because I'm a fan of alliteration, because it helps with the memory, dot, and then you have ing words because they're continuous. They lie on a continuum. And when we're planning, right, then we have aligned our investments to other areas as well, because investment planning encompasses other areas of our life. Life and money work together, Peter. You know that. Life and money work together. So when you're planning, right, you're encompassing, right? As I just coming to America, at the end of the movie, it's like, what's wrong with the soup? Anyway, but when you're planning, you're encompassing all of these areas, life and money, and you're aligning the whys, and you're also considering the other areas. So when one decision is affecting another, then it's like, okay, this is why I'm investing this way. And you're planning because depending on the life cycle, depending on the events, depending on the transitions that you're making, where your other investments are, just all encompassing where you are. So planning is all encompassing. It's integrated. It's allowing for flexibility and all that. So it's more comprehensive in nature. Whereas the investment management, when we're talking, you're talking about getting in there and making this decision. You're having to look at the nuts and bolts of the portfolio and making decisions, like all the stuff that you said, the mechanics of it, And now you can do that yourself. An individual could do that themselves, all right, or they can partner up with somebody, as we know. But it's just a mindset. It is the mindset of separating those two. And if we're investment planning, and if we've had the conversation up front about expectation and alignment, then our approach to just our centeredness during these times is different. Our conversation has different tone. It's okay to have some anxiety right now. Even the best laid plan and the best centered person is going to be like, hey, listen, I'm like, hey, it's a lot of red out there right now. And we do what we do, right? So it's okay to have that. However, if you have these mindsets of investment planning and setting the table and the expectations beforehand, then we have a framework and a foundation in order to be able to reset some of our feelings that we have.
So, Preston, I want to unpack a couple of those things. If we were to workshop the why people invest, there's as simple of reasons as, look, we can't put our money in cash. We have to outpace inflation, so we got to take a little bit of risk. But the whys we hear are retirement or paying for education or just like the freedom to choose what you want to do with your life. And then it's the how. How are you going to, I heard you saying, how are you going to place these assets in certain areas and at different times? And the when are we going to update this? But you also talk about the setting expectations. Maybe you could sort of give me a mock situation. I know you are a practitioner as well. If you're working with a new client and they've developed a financial plan and you want them to have the right set of expectations, what are you going to tell me, the client, in advance of beginning this relationship with you?
Right. So, I mean, I would ask, what's been your relationship with the market thus far? Obviously, you go through the tolerance type of question. You've already done some sort of assessment already, so you know where they are. In periods of duress, how do you feel? How have you felt in the past? What have been your decisions, right? Your feelings, and what have you done with those decisions? How have you felt, and how have you reacted to that, right? What would you have done differently? What would you have liked to done different? What would you have liked to feel differently? All right. And how would you have to do that going forward? All right. So what if we experience that again? Because we're trying to establish a tie of, okay, what have you experienced before? And then what, again, we're talking about expectation. Okay. What are we going to do going forward, and how are we going to have some consistency going forward so we don't go in and out of emotion and reaction, and that we stay in tune with our planning, and not just our investment planning, our planning of our life and money goals. Because once we receive information about how someone has experienced previous market cycles and what their reaction to that was, and we asked them, okay, what would you do the same thing? What would you like to do differently? Then we get a establishment of pattern, or their own kind of somewhat of a personality of what they would be doing in these situations, and then we can start having a conversation about that. And see, they feel heard and validated and valued at that point, Peter, and it opens up the platform for conversation, because they feel heard at that point. They get to tell their story. Okay. Then that opens the door for education. Then we're talking about setting expectation again. Then you're saying, okay, well, these market cycles or these ebbs and flows happen over the course of time. We have then we start getting into what you talked about. We get to talk about a little bit of inflation. We talk about ups and downs of the market, this, that, and the other. But that person, we as human beings, we're not going to hear all that education and information. We want to be informed. I had a client here recently. He said, what are the outcomes of this relationship that you want, that would be that you would find a success? The question. And they say, okay, these are my goals. ... All right. And then the person shared with me, I have one more thing. Would you just educate me? I want to be informed along the way. But you know what? He also shared with me, I've never been asked some of the things that you've asked me. I haven't been trusted enough to share some of the things, so I appreciate you. So my point about that is, when we ask how they felt, what they experienced, what they did, what they like to do differently, what they expect going forward, that opens up the conversation for the education.
Well, I really appreciate you playing along with me and sharing some of those questions. And what's interesting about your client is, I was making a note here. There's a clinical psychologist, Joy Leary, who was a guest on the show before, and you probably know Joy.
Joy and Brian, yep. Shout out.
Well, and Joy once said to me that advisors need to listen like a therapist. We teach advisors to talk about the ups and downs of the market. And I love that you're leading with unpacking some of these things that honestly would be impossible for a do-it-yourselfer to do on their own, to unpack their true, honest experiences with money, build that trust to open the door, open the conversation, as you put it, to then have that education. Because one of the things that I've come to realize from reading enough behavioral finance material is that once someone has an idea in their head, they're hardwired to do everything possible to validate that idea and ignore anything that conflicts with it. And so building that trust is so important. And I think that's so interesting that you bring it in, that you follow that order. And, again, given your background, not a surprise that you're thinking forward in this manner. I do have a question. So as you're going through an event like now where we're in correction territory, maybe we go into a recession, maybe we don't. There's a little lag on when we're recording this versus when it's airing. So interesting timestamp I just put on that comment. Do you feel like it's okay to de-risk at the portfolio level, whether that's in a situation like now or, when are there times that it would be okay to do so?
Yeah, there's so much commentary on what is considered market, quote unquote, timing, right? By the way, shout out to Joy's column. I like her. I read her column.
It's great. Her Substack. I'll make sure to link to it in the show notes. Anybody watching us on YouTube or listening on the podcast, the longterminvestor.com for show notes. We'll be sure to link to her Substack there. Yeah,
for sure. And I'm coming out with my own more blog on the regular as well. So yeah, people consider what's the market timing and this, that, and the other. So I used to manage money, a portfolio at a firm, and we just managed risk at the portfolio level. We had different type of portfolios based on the investor's risk, whether it be moderate, right, high risk, low risk. You had either 40, 50, 70, 80, equities, right? And then whatever your risk tolerance is, that's how much equities you had, and you had, of course, satellite, that, and the other. And based on all types of research that we did, because these were clients that allowed us to manage their portfolio. They just weren't do-it-yourselfers. There was a lot of research that went into there because they trusted us and said, okay, what are you going to do? Then we de-risked at the portfolio level, considering. So like you said, at the timing of this podcast, how long are we going to be in this cycle? Because we're talking about economic cycles. How long are we? We don't. Nobody knows that. That said, we do have economic cycles and we do have information, and there are elongated cycles. And can you manage at the portfolio level? Well, there's sometimes when we take, oh man, I'm about to say something. We take chips off the table. I almost chewed that down a little bit. I was about to say either that or take dry powder. Oh my goodness. But anyway, so I think we could do the opposite. And if emotions are managed, if there's a system in place, Peter, to where there's a lot of research. But the thing about it is that takes outside help in order to do that, I would think. Or if you're doing it yourself, it takes a lot of research. The thing about doing it yourself, or if you have a firm, either way, time and information in order to de-risk at the portfolio level. But that still involves, Peter, just still staying invested. If you have 80% equities and you de-risk a little bit to say 60% equities, that still means that you're invested. You're not cashed out.
Right.
Right. So it takes a framework and a system in order to de-risk. But yes, you can de-risk at the portfolio level. I believe that's okay.
Well, and by having a system in place, it sort of goes back to that idea of investment management versus investment planning. That system in place, that's the planning. And just for our listeners in the context, let me drop a couple education points. Just because, again, there's going to be some lag between when this is recorded and when it comes out. But the average drawdown in the S&P 500 is about 14%. And that's what we're down now. And actually, let me rephrase that. That's the average intra-year drawdown. So what we're experiencing right now is completely average, which when you step back and zoom out a little bit and you think, okay, so what we're going through is normal, even though we told you, both Preston and I, we tell our clients in advance, hey, market's going to fall 10% on average every year or two, 20% every 3 or 4 years, 30+% once a decade. Okay, we know that, but maybe we also need to be telling them the average intra-year drawdown is 14%. That's what's happening right now. And maybe it turns into a recession, maybe it doesn't. The average length of recession is something like 380 days. And so you think about, okay, what is the system? And hopefully you're in a portfolio that acknowledged that these downturns are always going to happen for who knows what reason, but they're going to continue happening with a similar magnitude and frequency as they have in the past. And to your point, Preston, if you make some tweaks, the important thing is to stay invested. To stay invested at times like this, that's really when that's really where you could make the big mistake, is not staying invested. And what's interesting about the time right now is people are questioning whether they should stay invested, whereas seemingly moments ago, there was all of this FOMO going on. Everyone was getting rich, and there was all these shiny objects in the financial atmosphere. And maybe you could talk a little bit from your experience and your studies, how people, while they may not be feeling FOMO now, undoubtedly human nature is cyclical. Just like you said, there's cycles going on. How should people think about FOMO? How can they curb FOMO? And for whatever reason, if people don't know FOMO, I don't know why they wouldn't at this point, but fear of missing out. How do you scratch that itch in a way that's responsible?
Yeah, it's a great point. I loved your analysis on that education that you just dropped. I mean, because there was some, like I call money dimes, money dimes, dropping some money dimes there. But that education there, if you were to introduce that up front, that takes us all the way back to the front, Peter.
Yep. If
that is dropped up front, that helps a little bit. Now, but in real time, people are like, I know you told me that, but dang, this kid feels.
The long term is an eternity to live through in the moment. So I say, like, hey, the average bear market's only 2 years or a little less than 2 years. You can live through this. But today at the gym, I'm doing planks and I'm looking at a watch, and all I know is I have to do the plank for 2 minutes. But if I watch the seconds tick by, it feels like I'm doing that plank for an hour. And if you're watching it, oh my goodness. And that's the thing is, again, investment management versus investment planning. Let's have a system in place for when things are bad. Let's also have a system in place when things are good. And you want to invest in every single thing that's going up because it feels like you're the only one who's not getting rich.
Right. So there has to be a system in place for that education on the front end, setting expectation. And then 2 years is a long time for a lot of people. So we have to be real and say that, yes, even when things are going up, we reallocate, don't we? I mean, we reallocate the portfolio even when things, that's why I said, take chips off the table and all this other stuff. We take gains and all this other stuff, don't we?
Yep.
So why can't we do the same at the portfolio level? 2 years is a long time, so why can't we de-risk, and when a system is in place and we have all that? So that's something to think about. As far as FOMO is concerned, I've posted something before. It's, FOMO over FOMO, FOMO greater than FOMO. So it's FOMO over FOMO, which is focus on moving on is greater than focus on missing out. And focus on moving on with what you're doing. Focus on moving on with your plan, is greater than fear of missing out. So that goes back to, why are we here? Why are we doing our planning? If the market is doing, 30% or whatever it is, okay, and it's just hypothetical, right? At the time, and you did, say, because of diversification during that time or whatever, or your risk tolerance or capacity, because risk tolerance is different than capacity, that's a whole oof. All right. So, all right. And you did, I only did, 18%. Well, factoring in why focus on moving on with your plan. Let's revisit that again, because remember that the expectation when we set the table, it's okay to hear folks. We should be hearing people and hearing those. Why did I only do 8? Why do we only do? We have to empathize with those stories. We have to listen to that. It's a genuinely, good question. People want it. We have to listen to that. Also, too, but because we set the expectation on the front, mutually set expectations. We didn't tell them. We weren't preaching. It's a partnership. It's a mutual exchange of dialogue, because after we heard them. But after that, we get to have that education thing and say, okay, yes, 18%. Okay, all right. Yes, we're on our way because we're focusing on moving on with our plan, FOMO over FOMO, right? Then there's another thing, Peter. It's like, look, I'm writing a poem right now, but one of them is about dry powder. I know we're doing these cliches, but one of them is, I think the poem is going like markets incline, markets decline, and then there's something about market time. Markets go up and down from time to time, something like that. So it's a little rhyme, it's a little funny rhyme, and then something like dry powder for itches, something like that. So
I like
so
that.
I'm right. So anyway, but the thing about it is that it's like a core satellite approach. You core satellite approach, and then you have some money around, for those itches. It's like, look, if you want to have some cash, hey, it's good to have cash around to participate, but have at it. That way you are scratching those itches. Like that way you get to have a little, whatever, your fun money or do what you need to do. It's like, okay, yeah, I heard about this great stock. I want to buy the dip or whatever, this, that, and the other, but it doesn't affect, your plan, right?
Sure.
So, hey, go right ahead. So those are two areas that how you can, address the FOMO. Focus on moving on with your plan, with the things that we've been talking about, the framework, having that conversation, empathizing with the client, hearing things out, decoupling planning from investment management, and then also having some dry powder to take care of itches.
I like that. And I always tell people who want to own, whether it's individual stocks or more recently, sometimes people are wanting to get into different crypto coins or NFTs or basically anything that deviates from the investment plan. Because the investment plan, it assumes that you basically never win. I think a lot of times when I talk about a diversified portfolio, I will joke that you're well diversified when there's a part of it you don't like. On the flip side, the more positive spin of that is that a diversified portfolio should never win. It should never have the highest the highest performance. If you somehow beat everything, you are not diversified. So you're doing it wrong. And I think people overestimate how hitting a home run on one investment can make a difference relative to how having just very average returns for a very, very long time, which one is going to play out better. And I think that, again, emphasizing whether it's at the beginning, in the middle, as we're going, it's tough to live through in the moment. And, I keep circling back to the fact that when things are going bad, you lean on that plan. We keep going back to this, investment management, investment performance versus the planning. But I also do want to acknowledge that anxiety is normal. I think sometimes advisors can get in a place where they're looking down on clients for feeling anxious about the markets. I will admit, I don't look at the markets that much. Whether it goes down 20% or 40%, my feelings are about the same regardless. But there are sometimes people who have anxieties or stresses that reach a different level. And so I'd mentioned at the intro that you are the president of Financial Therapy Association. And Preston, I was curious if you could talk a little bit about what might be some signs for people who are listening that are nervous about the markets to a point at which maybe they need more than just a phone call from their advisor. Maybe they need a little bit more of active therapy to address some of these money issues.
Yeah, that's a good question, Peter. And, first of all, financial therapy, the framework deals with how we think, feel and behave, about money. So that's the framework. And also, too, just financial psychology, financial, so many behavioral aspects, right? Behavioral finance. These areas allow for the practitioner, right, to open up dialogue with the client, to listen. And we kicked off the show with this a little bit. All right. And when you're servicing a human being, you have to realize that they do have human aspects, and they have to be heard, Peter. They have to be valued, understood, and just listen. You have to ask the right questions in order for them to share how they're feeling. It takes courage to ask these questions, and also courage to share from the person that's sharing them with you. All right. So that environment has to be created in order to have the dialogue with the client. That's number one. And then the practice of, say, financial therapy, because we're not talking about clinical therapy to where, you're on the couch, so to speak. Now, that's a whole different thing. These are blending, when you're talking about financial therapy in particular, you're talking about blending psychology aspects and bringing them with financial aspects and bringing them together. At least that's what the research is. And you're creating these frameworks in order to formulate tools and techniques in order to have a client and practitioner framework in order to work through some of these areas, right? And more than likely, when you're talking about financial therapy decoupled from the financial planning process, then you're talking about an area past and present that is causing so much of a significant barrier that it needs its own attention. Okay. Now, you can also practice financial therapy as a tool of techniques within the financial planning process to where it's not such a significant barrier. That practitioner just has the tools and techniques to work it inside the planning process. Okay. So they just have the skills to do that, and you can address it, hear it out, work through it, and then continue on with the plan. So it's two ways in order to do that. All right. Now your question is, is there a time when there is something so significant? What are those signs from somebody? Well, what happens when somebody is sharing a past experience with money, particularly investments? Maybe it's from a relational aspect or a individual aspect, to where that experience with money was so trauma, right? A traumatic experience, money scarcity, that it will keep them. They not only cash out, they don't want to have anything to do with the investment market anymore because of this experience. Maybe it was familial, maybe it was, a triggered emotion, this, that, and the other. All right. It was so severe that, okay, we need to have a pause moment. Okay. We need to have a pause moment. And if the professional, the financial planner or advisor can't, and their tools and techniques doesn't allow them, their skill set doesn't allow them to just broach the subject and just, hey, let's talk this out. Let me hear you, this, that, and the other. Then maybe that needs to be decoupled, and a financial therapist that just practices financial therapy, then they need to address that. So they need to come out of the financial planning aspect and see someone to work that one thing out until they can healthily come back into the experience.
I really appreciate you sharing that, Preston. Very informative. Certainly something that I'm going to want to dig into right when we get off of this call. I do want to ask you a few closing questions that I ask all of my guests. And the first is just for some general recommendations, whether that's books or podcasts for people to learn more about the things that we're discussing or that were maybe particularly influential to you. And hey, if you want to throw in some music recommendations, by all means.
Oh, wow. Okay. So books. Now, since we ended on financial therapy and we've been talking a lot about emotion and the like throughout the show, because man, right, they are inextricably linked as far as the money mechanics and money emotion. All right, the CFP board just came out with the Psychology of Financial Planning. There are some fabulous folks that participated in that book. A lot of folks at the Financial Therapy Association contributed to that book. So it just came out. So the Psychology of Financial Planning. So check that out. Fabulous authors. You're talking about pioneers and what we just talked about. Sandra Davis. Oh, wow. I mean, there's so much. I don't want to even start with shout outs because there's so many people that contributed to that book. So shout out to all the contributors to that book. I want to shout out to a couple of your client's story, Mitch Anthony. So Mitch Anthony is shout out to him. Getting Good with Money, Tiffany Aliche. She's a famous money coach. So, and also a friend of mine. I want to make shout outs to other authors that are not well known, but In the Meantime, which is Shihara Wooten. So it incorporates some of the Kinder, Mitch Anthony type of aspects, and also gives a historical account of the historical relevance of the Black American experience with finances. So that's a book. And also too, far as charitable giving, there's a book called Madam C.J. Walker's Gospel of Giving by Tyrone McKinney Freeman. So that's another book. I love philanthropy, And this one talks about Madam C.J. Walker, who was entrepreneur in Black beauty products, and Tyrone McKinley Freeman is a leader in the philanthropic space. I think it's at University of Indiana. He wrote a book about her philanthropic giving. So I know we hear about the Carnegies and all of the other world and all that. So I just like to throw in. There's been other philanthropic influencers as well. So and then also too, I mean, I'm a fan of let's see, Paulo Coelho, The Alchemist. Throwing it in there. Other books. What is that? Brene Brown. And I like that. I like those. And and then all the money aspects. As far as psychology is concerned, you got Brad Klontz, you got Mitch Anthony, you got Kinder, and you got Ed Combs and all that. So just a whole litany of books.
Yeah, that's a treasure trove of information there that you're sharing with us. And so hopefully people come and go and check some of that out. And the final question that I want to ask you, Preston, is what does it mean to you to be a long-term investor?
Yes, long-term investor is to have some INGs in your life, which is planning, because you're investing as a tool to support your what I call life money balance. Your life and money are working together to achieve your life aspirations, and when you're investing, you're investing long-term across multiple life cycles in order to achieve life aspirations according to your life aspirations, right? So being along is being committed to that. So when you know where direction that you want to go, creating your life's design, then you invest accordingly. And when you have set expectation in the front, Peter, then it helps you through calm times, periods of certainty, and periods of uncertainty.
Great answer. Preston, thank you so much for being here. I'm going to link to a lot of things in the show notes at thelongterminvestor.com, including where people can find you. But maybe if you, just for the audience, tell them where they can find you on social, the podcast, the website. Give it to them all, man. Let's make sure they can find you easily.
Man, appreciate you. So they can find me at the handle Dr. Preston Cherry. So that's Dr. Preston Cherry. So Twitter, LinkedIn, Facebook, IG. So same handle. And then concurrentfp.com. Find me there. The podcast is Life Money Balance Podcast. And then the YouTube channel can be found with Life Money Balance as well. Wait for it. It's coming. It's going to be populated. Oh my goodness, it's coming. It's going to be coming with a splash on the YouTube. So that's
you gave me a sneak peek. I know it's coming out, so that will be live by the time this episode drops. So for all of you who are watching us on YouTube, not only should you be liking and subscribing to this channel, but make sure to go and check out Dr. Preston Cherry. Again, thanks again so much for joining me. And for all of you watching and listening, until next time, to long-term investing.